So, hi, everybody. I'm Tim Daigle, co-founder of the Faith-Driven Network of Pittsburgh, and I want to welcome everybody to our March Treasure Talk series, or it's our spring series, and this is our March episode. The purpose of the Faith-Driven Network of Pittsburgh is to connect, inspire, and equip entrepreneurs and investors to promote flourishing on earth and treasure in heaven. We launched our 2024 Treasure Talk series for investors looking to produce kingdom returns on their assets. Now, we're all used to using profits from investments to support our churches and nonprofit ministries. But the idea of investments themselves producing kingdom return, that was a new concept for me. I think it's new for a lot of us, and it's really what we're here to talk about. But as with any kind of ESG or values-based investing, it can be vague and kind of ambiguous. So really the dialogue tonight is meant to really spark that, challenge each other and do this learning together. Last month, we had John Coleman and Matt Munson from Sovereign Capital to discuss faith-driven investing in private and public equities. We learned that there are companies that are with overtly Christian missions and visions that are publicly traded. We heard about Sovereign's hypothesis that the higher a company scores on their spiritual integration index, the better the financial return. So if you missed last month's talk, you can catch it on our YouTube channel, Faith Driven Pittsburgh. Just search for that and you should be able to find it. Tonight is episode 2 of our Treasure Talk series, and our topic is self-directed IRAs. This is a valuable tool that Christian investors can use to invest in non-traditional assets, real estate, angel investing, private equity, crypto, commodities, and a whole bunch. We'll be talking about a lot of that tonight. We have 2 experts to present tonight. Todd Arbutina is the founder and owner of 3 Chord True Wealth Management. Todd is a CPA, a certified financial planner, and a certified Kingdom advisor. Josh Bryan is the founder and owner of Freedom Trust. Josh is a CMU grad and a serial entrepreneur. He's accomplished a lot. He recently left a job at Google to devote himself 100% of the time to running Freedom Trust. So welcome, Todd and Josh. And with that, I'm going to turn it over to you.
All right. I think I'm starting the presentation. So Josh, I think you have control, right?
Yep, I'll share my screen here. Can you see it, Todd?
Yep.
Okay.
And again, my name's Todd Obertina, and I go back many, many years. And the full disclosure, Tim and I we're affiliated with this firm called Arthur Andersen. If you're familiar with Arthur Andersen, we had a little bit of a jaded history. We were not on the Enron account. I know I was not, but that's where I learned the trade of becoming a CPA back in the mid 80s. And then I matriculated to the small town of Beaver where I'm from, and I started a CPA practice focusing on taxes, closely held businesses, frankly, a lot of closely held business owners, and then added wealth management. I added it the late 90s because I had a lot of questions that people couldn't answer in the business. I said, well, I'm going to learn this business, and added wealth management from a CPA perspective. And then a few years ago, I did merge my CPA practice in 2020 of all years. Not the best year to move 30 people to a new culture, but we did that in 2020. And then I really been focusing just on wealth management for individuals, closely held business owners. That's kind of my niche now. So the topic today, if you want to move on, again, is on self-directed. What is a self-directed IRA? Just from a little historical perspective, in my, I guess, almost 30 years of experience, I've had this topic come up from time to time, but I can't really recall. I'm trying to recall if I've ever seen one of my clients actually go through and do it, to be honest with you. Now, I have done a few transactions in self-directed IRAs, and they're real estate, and I'll explain maybe a little bit later on why I did it. But in general, I really haven't seen a lot of clients actually go through with it and actually invest into some of the alternatives. But in any event, I do think it makes sense for certain circumstances. So what's the definition of an IRA? It's very simple here. It's a trust. It's created in our good old United States for the benefit of an individual. You as the primary beneficiary and contingent beneficiaries in the event something were to happen to you. So I think probably most of you all understand what an IRA is. A self-directed IRA is just a situation where the non-traditional type of investments, i.e., mutual funds, stocks, bonds, exchange trade funds, we're all aware of. But there's just a plethora of IRA providers will hold those because they're fairly low risk, they're liquid and so forth. And when you want to start getting into more self-directed, rare investments like direct investments in real estate, you're going to have a self-directed IRA with a custodian who will hold those assets. So Josh, you want to go to the next slide? This is just a it's a very, very important slide, but there are certain disallowed investments that you can see in terms of life insurance, collectibles, S corps. But most importantly, the IRA cannot have transactions what we call disqualified persons, which is you or I. If we set this up as we're the IRA owner, we're the beneficiaries of the IRA, or our spouse, or ultimately family members. But let's just use real estate. Real estate's a very common investment people want to use within their IRAs. You can't go out and buy a rental property on the beach down where I was at Amelia Island and then go and use it. You can't use it yourself. You can't use it for 1 minute, let alone 1 day. There's no thresholds there. So you got to be very, very careful that you don't work on your real estate. You can't pull out a hammer and fix the toilet, and so to speak. All those would be disqualified transactions with disqualified persons, and it would in theory, if you were audited, it would disqualify the IRA, make it all taxable all at once. So very important context, but that's where people can get tripped up if they don't know what they're doing. Go, Josh, go to the next slide. So you need to select an IRA custodian. You need to choose a type of this self-directed account. We'll talk about that in a few seconds. You need to actually put monies into the IRA. You need to fund it either through rollovers or through annual contributions. And ultimately, you want to make an investment. So, okay, Josh, move to the next one. So selecting an IRA custodian, you must have a custodian. I've used a company called Entrust, but truthfully, in this day of the age of the internet, you can Google as I'm speaking for a self-directed IRA. You're going to find a tremendous number of hits for companies who will serve in this capacity. And like I mentioned, the one I've happened to use has been around a long time. It's called Entrust. They'll take care of of any type of regulations and reporting and so forth, which is very important. So you want to make sure you have somebody who's been in the business doing this for a long time. But there's many entities that will go out there and serve in this capacity. There, of course, are fees. The fees are higher, as you can understand, because there's a little more risk associated with these type of accounts. So I think Josh had done a little survey, but anywhere from $50 to $1,300 to set up a self-directed IRA with one of those companies that you can find on the internet, like Entrust. But you can go and you can find those fees readily available from those custodians. And then you have annual maintenance fees you mentioned from $200 to $500. Often that's driven by the value of the account. So if you got a piece of real estate, like I have a lot I bought, which I thought was a good opportunity. Raw land. It's based upon the estimated fair market values to what I pay on an annual fee. Okay. And then let's go ahead and move to the next slide, please. So that's step one. Step two, the types. I think you've heard there's a lot of different types of IRAs, and it's no different than a self-directed IRA. Is it a traditional IRA, which is usually pre-tax dollars? We call those qualified dollars, which are pre-tax, and you tax them generally when you pull the money out. A Roth IRA, which has some unique opportunities. A Roth IRA is where the money grows tax-free. You don't get a deduction on the front end contribution, but those dollars again will grow tax-free. So if you make an investment within your self-directed IRA and it has a great, awesome return, those dollars ultimately will be a tax-free return, which is probably the sweetest of all types of investments whenever you can grow something tax-free versus tax-deferred. Small businesses have SEP IRAs and simple IRAs. Those are just a unique type of IRA where you can actually put more money away often on a deductible or even as a Roth IRA. So there's various types of IRA accounts which are that exist in your traditional IRAs as well as the self-directed IRA world. Next step, you got to fund it. And that's obviously the rub is where do I get these monies if I want to make somewhat of a significant investment in an alternative investment like real estate? You could do a rollover from another IRA. You could do a partial rollover. So let's say you have another IRA, which I assume many of you folks probably do, and you want to make an alternative investment. You would do a partial transfer from an existing IRA under number two, or perhaps you have a 401k you've been investing and some 401ks allow you to pull money out while you're still working, age 55 and older. It's all driven by the plan, but these are places of liquidity where you need cash, where you want to fund your self-directed IRA so you can make an investment. Obviously, you can make annual IRA contributions. Right now, it's $8,000 per year for us older folks over the age of 50. But you're not going to make much of an investment if all you do is set up one for $8,000 and you're looking to do one of these alternative investments. I'm not sure it makes sense for that level of investment, but that's another way you can fund and get monies into your self-directed IRA. And those above transfers and rollovers are not taxable events. So when you make those transfers or those rollovers, it's simply what we call a non-taxable transfer. It would be reported on your tax return as a gross distribution, but it wouldn't be taxable. So these are ways you can get money into a self-directed IRA from existing vehicles. Okay. Step 4, now you make an investment. That's the part that I think the real questions is you would instruct the IRA custodian to make an investment. I had one recently where I bought a lot, so I had to do a lot of communication between the settlement company and my custodian in order for those funds to be ultimately distributed by wire to make the investment at closing. But it's not that complicated, but there is a process you need to follow with your custodian. The investment obviously has to be titled in the name of the IRA. You can't put it in your own name. If not, it's not in an IRA. So it's kind of a common sense, but you need to title the investment in the name of the IRA. So that's also a little bit of a hang up at times where you got to work with the realtor. You got to make sure through the closing process that they understand that they properly title the investment, the real estate in this particular situation, in the name of the IRA. And they usually are very precise on how they want that to be done. But again, there's checklists. If you're working with a good custodian, they've done this many, many times, so they have a whole roadmap that you can follow. So then you're getting into the various types of investments, and Josh is going to talk into more detail about these types of investments. But again, real estate's a very popular type of investment. Bitcoin is something else which is emerging, or private equity, private companies, angel investments is listed here, or something called an LLC managed by owner, checkbook control type of process. And again, Josh is going to speak to that a little bit more. So we'll touch upon that when he does his discussion. Okay, Josh, next slide. These are just some practical considerations, which I think we need to take a step back. If we have some younger folks on here under the age of 40, I don't know if we do. We all look kind of looking at the pictures I'm seeing. I think we're all a little bit older. But yours truly, whenever I was in my late 30s, Roth IRAs, Roth 401ks, if you became available. So I, 30 years ago, 30 years ago, made a commitment to funding a lot of my money into Roth buckets when I was younger, poorer, lower tax brackets. But I'm just trying to lay out strategies that, especially if you have children or so forth, or maybe a bit younger, that you need to build up capital, looking at the future, especially when it comes to some of these non-alternative or alternative type of investments. So it's a good idea to try to build up, and even doing what I call a non-deductible IRA. Everybody on this call, as long as you've got earned income, can make a non-deductible IRA contribution. I really, really counsel that folks do that even though they can't get a tax deduction. And it's not there, it's unlimited. You could be making $1 million a year and you can do a non-deductible IRA, build up that capital so you can have the opportunities possibly down the roads to make investments in these alternatives through a self-directed IRA. Another really important aspect that I don't think people think about is that if you're going to make a sizable investment within your self-directed IRA, i.e. something like real estate, which is not liquid, be mindful that when you hit the ages of 72, 73, 75, it depends upon your date of birth, but that's when something called the required minimum distribution rules kick in. And you're going to have liquidity to make distributions to meet those requirements. If you don't, you're going to be run afoul of the law, and you're going to have penalties and so forth. So you better just make sure that you consider the impact of the required minimum distribution rules with respect to this alternative of investment, especially if it's illiquid like real estate. The other thing would be, I just think good overall planning, that if you're going to make an investment relatively sizable, that you make sure it's done in a overall retirement investments philosophy, portfolio analysis, come up with an income distribution strategy, make sure it all ties together back to a plan, because I've seen there's been a tendency with clients. I did have one where sometimes they go to a presentation about, especially this, investing in real estate, and use your IRA. And unfortunately, I've had situations where people have come in, maybe taken 80% of their net worth, rolled their IRA, maybe they retired or had a job change, and they moved $800,000 to an IRA, and then they put it all into real estate, and they don't know what they're doing. Frankly, if you don't know what you're doing with real estate, it's just not that simple that you go out and buy a piece of real estate. There's a lot of moving parts with real estate, and that you want to understand that the fact it has to be managed, and there's going to be expenses and maybe illiquidity at times. So making sure this all ties together to an overall plan is really important in my perspective. The last piece is real estate investments in general, that there are real reasons not to put real estate into an IRA. And part of it is the fact that you have depreciation that you will lose. I mean, it'll still be there, but you just don't get the benefit of it within an IRA. So you really want to run some numbers and consider the trade-offs of having losing the depreciation associated with real estate when you put it into an IRA. So I know this is somewhat quick, and we'll be able to, after Josh speaks, we'll be able to come back and you can ask questions and so forth. But I like real estate. Like, for instance, I bought some real raw land or lots or so forth with a Roth IRA I had, and I've done some flips. There's no depreciation associated with it. So, I've done okay where I've identified opportunities to buy a piece of property with my Roth and then turn around and flip it, frankly, and make a tax-free return. But I'm not saying I'm good at it, but you've got to be good at it. You got to make sure you pick opportunities where you feel pretty good of the fact that you really are making a good, you see an opportunity of value there that you believe in, that you can turn around and make that investment and turn around, sell it, and maybe have a tax-free result. So those are some practical considerations, but I do think it's important for people to consider these as well when they're making these types of investments with a self-directed IRA. And I think that's the last slide, right? Josh, from the tax point of view?
Yeah.
Yeah, so and then we're going to move over to the investments here, and we can obviously have questions later on.
Okay. Hi, everyone. I'm Josh Bryant. My company is Freedom Trust. I've been an investor and advisor in Bitcoin and cryptocurrency since 2018, when I left a corporate job to join a small cryptocurrency startup that was on the north side of Pittsburgh. And I have a background in banking and technology, spent the first decade of my career at a large custody bank, followed by working at several startups, and spent the last 3 years at Google in their shopping division in Bakery Square. I established Freedom Trust in 2020 for Bitcoin and crypto advisory services, and the company provides custody solutions for Bitcoin and crypto. And I've also set up a self-directed IRA LLC for myself and for others in order to invest in Bitcoin and crypto in a tax-advantaged IRA account. And I'll be talking more about the IRA LLC in a little bit. As Todd was saying, self-directed IRAs can be used for alternative investments. Typically, if you open up an account at a brokerage, you can only invest in stocks, bonds, ETFs, and so on. With self-directed IRAs, you can invest in alternative assets, which can be very beneficial if you already have expertise in that particular market. And you can make many types of alternative investments. And I've listed some of them here. Todd was talking about real estate. I have experience in cryptocurrency. You can also put it into private equity, angel investments, venture capital, and the rest of the items that you see here. You can make any investment that is not prohibited by the IRS. So no collectibles, no life insurance, no S corporations. But every other type of alternative investment is permitted. So there's a wide range of different alternative investments that can be made through self-directed IRAs. I'm going to do a deep dive into Bitcoin and into real estate to give you an idea of the different ways that you can invest into these alternative assets with a self-directed IRA. The first option for if you wanted to invest in Bitcoin would be to invest in a Bitcoin ETF. The ETFs have recently been approved by the SEC. And so you would be able to go into your brokerage account where you had an IRA set up with a brokerage account, and you'd be able to purchase a Bitcoin ETF. An example here would be logging into Schwab, setting up an account there and buying a BlackRock Bitcoin ETF. That ETF will track the Bitcoin price, but you have to deal with multiple levels of custody risk there. For me, being in crypto, I want to be able to take custody of my Bitcoin private keys, which you're not able to do with this option in purchasing an ETF. But for those who might just be interested in tracking the price, ETFs have recently come on the market and are available. A second option is a crypto-specific self-directed IRA. So there are companies that have been established that are specific to IRAs for Bitcoin and cryptocurrency. And for instance, Bitcoin IRA, you could create a self-directed IRA account with them. And in that account, you could log in, you could purchase and trade Bitcoin and cryptocurrency within that account, all within the tax-advantaged IRA, your traditional IRA or a Roth IRA. And some companies have established Bitcoin-specific IRAs that actually allow you to hold the private keys yourself. So this is a newer development, newer product. There's a company called Unchained IRA that allows you to do that. And then the third option, which is what I do, is set up a self-directed IRA LLC, which is managed by the IRA owner. And I'll go into a little bit more in depth on the setup of this structure in a little bit. But with the self-directed IRA LLC, the IRA owner can go in and purchase and trade Bitcoin and crypto in a self-directed account. And then the LLC can also, if it wishes to, take custody of the private keys of the cryptocurrency. And that same LLC can be used to invest in other alternative assets. So the LLC that I've created for myself can invest not just in crypto, but I can invest in stocks, real estate, any of the other alternative assets that I had in the previous slide. A deep dive into the real estate investing is similar to what I just walked through on Bitcoin and crypto. Option number one would be to buy a real estate investment trust product through a brokerage like Schwab. Again, you could set up an IRA through Schwab and you could buy a REIT, which will track the price of real estate. But again, you don't necessarily own the underlying physical real estate. A second option would be a self-directed IRA managed through an IRA custodian. And this is what Todd was talking about with what he set up with Entrust, where you set up the IRA with the custodian, and it's for the benefit of you, the IRA owner. And here you could make an investment into a physical property. And then all requests for investment have to go through that custodian. So anytime you want to make an investment into a property or pay for expenses, you have to call up the custodian or contact the custodian, and they're the ones that have to move the funds on your behalf. So there is some effort in doing that. With the self-directed IRA LLC, the IRA owner controls the LLC bank account, and so the LLC is the one that's making the transactions. The LLC holds title to the physical property, and that LLC can also invest, as I said, in other alternative assets as well. As an example, I've put in Burgo here as a sample private real estate fund. Again, that LLC can invest in multiple types of alternative assets. So the last slide is a description of the self-directed IRA LLC with checkbook control. You may have heard of that term. In this structure, the IRA invests 100% in a limited liability company. They're the single member of the LLC. So it is owned by the custodian. They are still the legal title holder of the LLC. However, in the operating agreement, the IRA owner is named as the manager of the LLC. And so the IRA owner, as manager of the LLC, can make decisions as to what the investments are. So the IRA owner controls all investments. So your IRA custodian will roll over the money into your LLC bank account, and then you have checkbook control as the manager of the LLC of that bank account, and you can make investments into different alternative assets. All the investments are titled in the name of the LLC, and the LLC owner and manager is responsible to communicate the value of the LLC assets to the custodian every year. And this type of structure is recommended for if you're going to invest in multiple alternative assets rather than paying a custodian their fees to invest in multiple assets. You pay the fee once to have them fund your LLC, and then you can use that LLC to invest in alternative assets like real estate, Bitcoin, private equity. Or you may have a real estate investment where you want to pay expenses. You have a lot of expenses that you want to pay on that investment. You pay it out of your LLC bank account rather than requesting the custodian to make the expenses. Or you may want to move quickly on a property and you have the cash in your LLC bank account. And rather than having to wait for the custodian to transfer the funds, you can issue the funds yourself with checkbook control over the LLC bank account. And then the structure also allows you to take your own Bitcoin private keys into custody through the LLC. So some of the SDRA products that I mentioned before, you're not able to take custody of the Bitcoin private keys. With this structure, you can. So that is the end of the presentation on different types of investments. I've covered two of the ones that we have experience here. I with Bitcoin and cryptocurrency, and Todd with real estate. There are many other types of alternative assets that you can invest in, including companies, precious metals, many other types of things. Are there questions?
Great presentation, guys. I've got a bunch of them, but we'll see. I'll let other people ask too. Maybe I'll just get it started. Todd, is there a rule of thumb that you have or that you're aware of from Kingdom Advisors or others that you've worked with just on, what percent of our retirement account should we consider? Like, is it 100% or are these riskier? Do these tend to be riskier investments and therefore prudence would say we should have some kind of at least personal limit on it?
Yeah, I mean, in general, just as a wealth advisor, you usually have a rule of thumb that you don't want to put more than 10 to 15% in any particular, one investment, so to speak. I mean, I think the issues when you start going into these alts, like real estate, now you got liquidity. The number one issue is liquidity. People need to understand the liquidity issue, but so if you're saying 10 or 15%, that percentage is much different depending upon the size of available assets. For some clients that could be $300,000, and other clients it could be, truthfully, it could be $50,000. So when you start talking about $50,000 or $30,000, is it worth? You start saying, is it worth the extra worth and time and expense to move the needle in the overall investment plan? So, but yeah, just rules of thumb. You just don't want to over allocate to one particular investment, especially I think these are more risky because of the fact that real estate just has more inherent risk of a lack of liquidity potentially, or the location, so to speak. Because this might have sounded really good if it was 2006 buying condos in Myrtle Beach. We all know what happened there in terms of taking people were overloading certain areas. So just follow prudent practices of not putting too much eggs in one basket, so to speak.
Yeah, and I say the same on Bitcoin and cryptocurrency. When people are just getting into it for the first time, I really suggest they don't put in more than 2 to 5% of their net worth if they're just getting started. And it is a more liquid investment, but it is something that has risk associated with it. And so it needs to be part of a diversified portfolio.
One thing related to the risky investments, if you're doing angel investing, let's say, or venture capital that's real heavy on the risk side, potential great reward, but on the risk side, it seems to me that you would only want to do that in an IRA in which you have no basis. So, for example, you wouldn't do that in a Roth IRA. You wouldn't do it in a non-deductible IRA where you have basis. From the perspective, if you lose it all, let's say you did an angel investment, you lost it all, at least you didn't use post-tax dollars in order to make that investment. So in effect, it's the equivalent to doing a charitable contribution. Does that make sense? Am I thinking about that right?
Yeah, yeah, and Roth IRAs, you obviously have basis to the extent that you've used after-tax dollars.
Sure.
And same with IRAs. And if you do, I never had this happen, but I'm trying to think of if you were to go bust on the investment, I do believe you have the ability still to recover that basis. I believe you do. I believe you do. I'd have to double check that, but it's never happened because of I've just had so few times where people were actually underwater in their IRAs, because usually they're long-term investments. If they've accumulated significant assets, usually their basis is zero in many cases on deductible, but even after-tax basis, it's usually there's a big difference between the basis and what the value of the investment is. But I guess the real estate is the one where I do want people to take a step back and understand the fact that you're losing the traditional merits of real estate investments, that you can lever it, right? You can put 20% down, and you have many, many banks out there willing to borrow. And you can actually borrow. There are banks out there with non-recourse financing where you could actually lever within an IRA. I haven't done this, but you could go out and borrow. The IRA could borrow funds and lever it, but you always still take risks there. But you do give up the value of depreciation, which is very considerable in real estate. It's why people do it outside of IRAs, because you get depreciation and so forth. You also convert, if it's a traditional IRA, you actually also convert all your gain to ordinary income. Whereas if you're doing real estate outside, you got a lot of games you can play, and they're legitimate, but 1031 exchanges is one where I have clients who traditionally, including myself, tend to build up your real estate bucket outside of an IRA, because you have a lot of good tax techniques you can use. And 1031 is it. And 1031 is where you decide to sell a piece of property which you've depreciated, maybe held it for 20 years. You have a significant gain. And this happens with a lot of my clients, and they're like, we don't want to pay this tax today on this $4 million gain. They can turn around and roll that and defer that gain into another piece of real estate investment. And this isn't a political statement, but the reason why someone like Trump doesn't pay a lot in taxes is because of the inherent um, tax, good qualities of investments, and using 1031s and so forth, where it's not unusual for me to see some very, very wealthy clients who really specialize in real estate doing very well, paying very, very little in tax over the course of many years because of the tax code benefits it. But that's something. There are trade-offs of using an IRA versus using traditional outside investment.
Okay, I've got a question. You said that I believe with the traditional or the Roth IRA that you can't have anything like if you invest in real estate, for example, you said you can't work on that real estate project. Does the same thing apply with angel investing with businesses you might invest in? You're not allowed to have anything to do with that business. It's got to be purely you're separate from it. So you can't advise, consult, anything like
You
that?
can't, yeah, you can't invest money into a private equity and become a consultant to that private equity. You can't receive remuneration. Now, if you have a piece of real estate and you decide you want to self-manage it, I'm talking, approve leases, do the bookkeeping and so forth. Now, you can't charge the IRA for the services. You can do that, but you
Mhm.
can't work on the property. You can't use the property. You can't, again, I used the rental property down at the beach. You can't turn around and have mom and dad go stay for a day or for a minute in theory. All that's deemed to be self-dealing. So yeah.
So basically, don't go near the property. Like, don't set foot on the property because it might be construed as being
Yeah,
if you
yes,
use
you
it
don't
in
want your neighbors seeing. Again, I think also from a practical point of view with real estate, people don't realize, oh, we got the real estate, the county real estate tax bill just came. It's, $2,200. They write a personal check. No, you just violated the rules. You need to turn around. You have to go to the custodian. Mine, you go online, you upload it, you make a request for funds. Then they'll send you a check directly to the county tax authorities, and you're following the rules. Or, if you have to have a repair, it's got to be funded within
Yeah.
the IRA. And if you're short funds, let's say you're short funds. I have a piece of raw property, so where I might become short funds, what I do is I replenish it from my traditional IRA. I'll turn around and just simply do a partial
Mhm.
dump in of money every few years if I need some cash. So
But
you have to follow that accounting
yeah. But it sounds
process.
like that's where the self-directed IRA LLC would be
There-
something you could use to then
yes,
just to
very
have your hands in the investment you're investing in.
yes. The
Okay.
self-directed LLC now becomes checkbook. You still need to make sure you don't turn around and put personal funds in that LLC. You got to fund it through the IRA down into the LLC, but it certainly makes it
Okay.
makes paying of expenses, and it makes buying up multiple investments much more efficient. So you don't have to sit there and work through the custodian through their documents and their uploads. You eliminate all that process. Plus, they charge you transaction fees. So every time I want a real estate check cut, it's like $25 to issue a check, but still, it's
Mhm.
$25, right? So
Yeah.
I'd rather avoid that. I haven't done the LLC, but I've only had like one-off properties. I'm not spinning off
Yeah.
multiples, but I think it makes a lot of sense if you get
So
kind of.
if you just want to be completely passive, than the regular Roth or IRA. But if you want to leverage your wealth of knowledge, even if it is risk, your wealth of knowledge can mitigate that risk in certain areas in order to invest in something you want your hands in. You could do the self-directed IRA LLC. Got it.
Yeah,
That's great.
yeah, yeah.
Go ahead, Dean.
You have any comment? You talked about all the benefits of the Roth IRA and the self-directed aspect. How do you feel about at a low level trying to combine that with a Roth conversion, subject to trying to keep your marginal tax rate down and understanding IRMA effects and everything, and maybe to my friends here on the call who are not on Medicare, to understand that maybe the time to do some of that is prior to being on Medicare, as I wish maybe I had done a little more of before I got on Medicare, just to understand
That's
that ramification.
that's a great question. We do that all the time with our emerging retirees or retirees, but just there are opportunities, and I think that maybe I'll just try to frame your question here. So I have many clients in their 60s, still many years away from that age 73 RMD where they have to pull out RMDs, but sometimes we know that when they have to pull those RMDs out, they're going to blow up into much higher tax brackets. And there's something called IRMA, income, retirement, Medicare adjustment. I think that's what it is.
Yeah.
IRMA is a fancy word for what that is that whenever you have to pay more into your Medicare contributions. So we have many clients where we're doing Roth conversions. In other words, we're taking money from a pre-tax IRA bucket and we're moving it, and they're paying tax on it pre-73 or in their 60s, and keeping them within certain tax brackets. Also being mindful of not tripping them up and putting them into another IRMA bracket where they're paying more to Medicare. That's always looked out 2 years in advance. So now how that all ties back to self-directed IRA, I think, is just simply, do you want to add some of these alternatives in to your investment portfolio mix, your IRA mix, so to speak. So, but that conversion, those dollars could be they could be a funding source for alternative investments if you so choose. Real important to understand, though, you have to pay your taxes on that conversion. In other words, if you're going to take money and convert $100,000 from pre-tax regular IRA and turn around and put it into a Roth IRA to grow tax-free for the rest of your life, and let's say let's say that's in the 22% bracket, just for argument's sake, that's 22 grand. You're going to have to come up with taxes on the side to make that really make sense. So that's adding some complexity to this discussion. But yeah, we have many clients who are doing Roth conversions,
And the
IRA conversions into Roth.
the further importance of that is if you leave a spouse and they all of a sudden become a single taxpayer, it's much worse. And that's why you could leave a spouse who's now paying as a single and be in much worse situation having to take the RMDs.
Yeah. So I mean that part of this, we're going into
I
more
know,
traditional.
I'm off topic.
We're going to more traditional. Does it make sense to maybe accelerate before you get stuck grabbing a lot of money as RMDs at age 73 or 74? Now we do a lot of that, where usually people say, "Oh, defer," but we're no, run numbers for these various scenarios. And many of my clients, frankly, don't even need the RMDs, and then it becomes a question of just trying to figure out how you're going to deal with heirs and so forth. I mean, really, you're doing things for heirs 20, 25 years down the road. It could be a spouse, but often you're thinking about kids or grandkids at that point in time.
So Todd, you're saying that if, let's say I had 100,000 that I was going to move, and it's in a traditional IRA 401k, I could move it if I was setting up a self-directed IRA. I could set it up as a Roth, and I would just have to pay the taxes on that 100. Is there a limit on the dollar amount that I can do?
Nope.
No limit. Okay, I just have to pay taxes on it.
Yeah, I don't think there's any limit like there used to be. There's no limit on. I don't think there's a limit on. No, again, yeah, I don't think there's a limit. Nope.
But you climb up the marginal tax bracket quickly, and you climb up the IRMA chart very quickly.
Yeah. So you got to do the trade-off. So are you guys familiar with IRMA? It's just simply everybody contributes. If they're 65 or over, everybody has a base contribution every month towards Medicare. It comes out of your Social Security benefit if you're receiving it. So you need to model these things with your eyes wide open to determine how much makes sense. But I have clients in higher tax brackets, higher earner brackets, but they got such big IRA balances they got to deal with that they're being proactive and they're actually doing these Roth conversions, even holding their nose with IRMA to get these buckets growing for 20, 25 years for eventually for their kids or grandkids. Now, it used to be a home run because you could stretch IRAs over your life expectancy. So if you had a tax-free bucket there in age 90, you die and you give it to a grandchild who's maybe 25, and they could stretch that same money over their life expectancy, tax-free, huge outcomes. That's all been dissipated because now they force you for your non-spousal beneficiaries, they have to pull that money out within 10 years. So they really took away that what's called the stretch IRA. It's not as sweet as it used to be.
But an IRMA penalty for a couple, it's nothing to see a 10 grand annual penalty for two people.
It can grow, yes, at the top it could be pretty high. That's a one-time. It happens for 1 year, and if you don't follow the same strategy, it will come back down.
Yeah, I know.
So
Then it gets down to a risk reward thing. Josh, I'm thinking of if I did a self-directed IRA into Bitcoin, and let's say I had the Bitcoin ETF already in an IRA, but I wanted to move it to where I could control the Bitcoin, and it's in traditional, I could move, it would have been nice during a bear market to move it over into Roth, because then all that upside that I've got in the last 12 months would not have been taxable, right? It would just been the original basis.
Yeah, I really like the Roth IRAs. I've
Yeah.
converted the majority of my traditional into Roth. I really like the Roth IRAs. It's my personal preference on that. But right, then any gains in the Roth IRA, you never have to pay taxes on. So that's a nice thing once you reach retirement to not have to pay taxes on whatever you're taking out of the Roth IRA. And as we were saying, in creating a self-directed account, you can create it as a Roth IRA, self-directed account. So you could put real estate into that Roth IRA self-directed account. And actually, once you reach, I think it's 59 and a half or whenever the distributions can be made, you could even take that real estate as an in-kind distribution. You could take the Bitcoin as an in-kind distribution out of that account and not pay any taxes on it. So the Roth is a really powerful tool.
But you can also take money out before 59 and a half if it's been in for 5 years. Is that right?
you can take your basis. You can take your basis out.
Basis.
You take your
That's right.
basis
The
out. So
basis,
whatever.
not the earnings, but the basis.
Yeah, the basis for 5 years, and then So, and I always try to counsel folks that if you're going to do the IRA, do it for the long term.
Sure, but I'm saying from an emergency standpoint, it's not really bad if you start.
No, it's not. It's just a matter of I hate to give up tax-free growth for anything. Yeah.
Yeah.
And that's kind of the thought process, because again, if you're even in your 60s right now and you decide for estate planning purposes, think we always talk about asset allocation, put some money into Bitcoin, but be allocated. But with Roths and conversions, that's the same philosophy as, hey, right now, if you've got almost all your money in big pre-tax IRAs, you're pretty much sold out to the fact that you're whatever the government decides those tax rates are going to be. And I don't know about any of you guys, but knowing and gals, we have significant debt problem as a country. So, do we think rates are going to be higher or lower? I don't think they're ever going to be lower than they are now. I think we've probably seen the lowest effective rates we may ever see. So the bias is that you're protecting yourself and reallocating your tax bracket, saying, well, I know this is all pre-tax. Well, I want to start to build up my tax-free bucket over here and get that diversified between the two. So nobody likes paying taxes early, but there are reasons to consider doing it even before your RMDs kick in.
Yeah, Todd, you had mentioned there's a bunch of different companies. One we had recently worked with was Advanta. I don't know if you've heard of them or not.
I haven't. I haven't.
But someone, yeah, they wanted to invest in our startup through their Roth IRA. And so we dealt directly as a company with, like you said, the IRA custodian
Hmm.
and no longer with the investor. They handle
No.
all the paperwork, they handle all the investment, all of that stuff. And some unique documentation between the IRA holder and them, and then between them and us. So it's kind of like this bit of a shield almost.
Yeah, you won't be dealing with, and that's the way it really should be. That's the way they want it because they don't want the IRA owner actually messing something up, so to speak. So yeah, I don't, like I said, the real estate I've done, it just was here's settlement agent, here realtor, just, and here's the contact at Entrust. Here's a checklist. It says how it has to be titled. Just make it happen. I mean, I really don't want to be, that's what as part of the transaction cost, I expect you to be able to make it happen because, again, you have to be careful, like certain things. If you're buying a piece of real estate, is a tendency to want to say, here's a $5,000 hand money, right? Where's that hand money coming from? Well, often it comes out of your pocket, not the IRA pocket, because there's a sense of time and element. And that happened with me too. I told a realtor, I need my hand money. My hand money has to be paid ultimately by the that was a Roth IRA. So when I went to closing, they reimbursed me for my personal funds. So it was 100% of the funds came from me. But those are little things that in theory,
Mhm.
that hand money, I could see that being lost in translation. In theory, I think the IRS, if they audited transaction, could blow it up if if they came across that. But it's something which is very common sense. Here's a check, realtor. Here's a cabinet bot, and you forget about that hand money
Yeah.
actually being paid by personal funds and not by the IRA funds. But these are little technicalities that could come back and bite you in the behind, so to speak.
Josh, Todd had a slide on traditional kind of fees that you'd pay in a self-directed IRA. Does it change with that LLC? Is it more expensive? Is it right in line with those numbers? What's the details there?
It is more expensive to set up the self-directed IRA LLC, and that's because you have to pay the custodian to set up the IRA trust as a fee to that. Then you also have to draft the LLC operating agreement. You have to register the LLC with the state. Then you have to open up a bank account in the name of the LLC. And in the case of Bitcoin or crypto, you'd have to open up the exchange account in the name of the LLC. So there are a number of steps, and the process is longer to get that set up. Once you have the LLC and you have cash in that bank account, then it becomes very easy to write a check for hand money out of that LLC bank account. And you can quickly move on real estate. You can make investments into different areas. So the setup can take longer and it can be more expensive upfront to create the IRA LLC, but it creates more flexibility for you. In case of Bitcoin, being able to hold your private keys in the name of the LLC, which is non-negotiable for me to be able to do that. To be able to make investments in multiple types of asset classes from the same LLC. And then I just pay the custodian once they consider the LLC that the IRA investment, right? It's a one investment. So the IRA is not investing in real estate here and crypto here and precious metals or some other alternative asset. They don't have multiple investments. They have the one investment in the LLC. And you're the manager of that LLC. You're responsible of tracking the assets in that LLC and reporting back to the custodian at the end of the year on the value of those assets. And they still report to the IRS every year based on the value of the IRA. I think once it reaches a certain level, it might be 250K or something like that.
Yeah, so from a practical point of view, I think that LLC makes a lot of sense if you're gonna. I'm sorry, yeah, the the single member LLC, checkbook LLC, if you're going to have lots of expenses to pay. So if you end up having a rental property with, you're going to have ongoing checks being written for multiple properties, I think it makes sense to consider spending the cost to set it up, because in the future you could just write checks for the plumber, write checks for and you're not going to have to go through that whole submission process to get it approved and then to ding you with a per check cost at the custodial level. So I definitely see the merit of doing that and spending that money. But if you're just going to do like a one-off, like I have a piece of real estate, just a lot just sitting there, I got to write basically 3 checks a year for real estate taxes. I'll just do the non-LLC and just have them hold it directly and just have them cut 3 checks a year. You know what I'm saying? So you have to do that trade-off and that analysis as to which way it makes the most sense.
And Josh, were you saying that if I wanted to do a real estate deal, commodities deal, and a crypto deal, I'd do that with 3 separate LLCs, or would I'd
No,
do that
that
out
would-
of the one?
One LLC, you're the manager of that limited liability company.
Okay.
LLC can invest in multiple things. That's one of the advantages of it. Whereas
Okay.
if you were using the IRA custodian, like Entrust or IRA Trust, you would have to continue to make multiple requests to the custodian to make that investment on your behalf. And that takes time and money for each one of those requests. To ask the custodian, the IRA custodian to do it, rather than you as the LLC manager being able to do it with checkbook control from the LLC bank account.
Yeah, I like that.
Other than reporting back to the custodian, the value of what's in the LLC once a year, what other type filings, IRS, or any other agency that you might have to report to? Nobody.
As long as you keep everything in the name of the LLC, you can invest anywhere, you can trade. That's one of the things I really like is I open up an exchange account in the name of the LLC and I can trade in there and it's all tax-free and there's no reporting necessary on any trade. So there's no reporting, I believe, outside of the IRS at the end of the year.
And your custodian, that's what they're being paid to do. They're going to give you the same forms that you get from any other IRA. If you make a contribution directly to it, and they're going to give you some, I forget the form, but to show you that you made a contribution. I think it's 5498 if I'm
right.
If you make a transfer back and forth or what have you, like a rollover, they're going to give you the 1099-R to reflect that.
Yeah.
Okay.
You have to make sure you fund it in the right way. So if you're rolling over funds from your 401k, or if you're transferring funds from a different IRA, it has to start by going into the IRA custodian's bank account, and then they will then transfer the funds from the custodian bank account into your LLC bank account. From there, you're then the manager and you can invest out from there. So it's important that you have that sequence of funds for it to be following the rules.
Yep, makes sense.
Any limitations on can you go take a 401k that you've had and roll it into that?
Well,
You can't.
when you get good, Josh,
I was going to say, if some companies, if you're working there right now, they won't allow you to take out your 401k funds unless they have something called an in-service transfer, which many don't. I know I didn't when I was at Google. The funds that I put in, I could not move out of that 401k. That was a planned policy, right, at Vanguard. But when you leave an employer, you can then roll those 401k funds into either the 401k of a new employer, or what I've done is rolled it into my own IRA.
Right. So with 401ks, you need to look at their plan specific, look at the summary plan description. You need to look at the plan documents. Now, for us older folks, again, Josh, I keep saying I'm older, but I am. Over 55, I think 55 is where now they've had situations where you can actually what's called an in-service distribution if you hit a certain age. That might be a possibility. But again, not all plans have it. It's based upon whether or not the plan decided to put that provision in. So 401k is a little bit more sticky in terms of getting assets out into an IRA.
And it's a good reason if one of your kids changes jobs to tell them not just do a knee-jerk reaction and roll your old 401k into your new current 401k, because you lose out on that flexibility.
Yep.
Yeah, that's correct. Now I'll tell you, fiduciarily, we have to be very careful when people make those decisions, explain the pros and cons of cost. But the IRAs do give some flexibility, and one of the flexibility is the self-directed IRAs. Now, I'm not saying the 401ks might end up, even this, Josh, I don't know if you say anything, but getting some self-directed investment type options within a 401k, and maybe, I'm sure crypto is going to be through the ETFs will be available. I'm not so much holding it directly, which I know there's the merits that the pros and the merits that you believe in terms of those private keys. So,
Yeah,
when
I was at Google, we had our 401k, but it was very limited at Vanguard, what we could put that money into. A lot of them were just target funds, but they did make a Schwab self-directed 401k available to us where we could move the funds over there and then trade in specific stocks. But again, it was only stocks, bonds, ETFs, those type of products. I couldn't put my funds into physical real estate, Bitcoin, where I can keep the private keys, any kind of other physical alternative asset. It was only what, Schwab had to offer through that account.
I get a bounce, but you guys are awesome. Thank you so much. This is
Yeah, Todd and Josh, thank you so much. We are a little past time here. So thanks everybody for joining us. Next month, we will be talking about donor advised funds, which is a whole nother option, right? And you could do a self-directed IRA and a donor advised funds. There's different purposes for each, and we'll get into that next month. So everybody have a great night. Todd, Josh, thank you guys so much.